Ladies and gentlemen, good day and welcome to the Neogen Chemicals Q2 FY26 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on the touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Nishit Solanki from CDR India. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and welcome to Neogen Chemicals Q2 FY26 earnings conference call for analysts and investors. Today, we are joined by senior members of the management team, including Mr. Anurag Surana, Non-Executive Chairman, Dr. Harin Kanani, Managing Director, and Mr. Gopi Krishnan Sarathi, Chief Financial Officer. We will begin the call with opening thoughts from the management team, after which we'll open the floor for your questions. Before we begin, a standard disclaimer. Certain statements made or discussed today may be forward-looking. Actual results could vary, and a detailed disclaimer is available in Q2 FY26 earnings presentation, which has been shared and uploaded on stock exchange websites. With that, I would like to invite Dr. Harin Kanani to share his perspectives. Thank you, and over to you, sir.
Thank you. Good evening, everyone, and thank you for joining us for our Q2 FY26 earnings call. We will walk you through performance and provide updates on strategic growth and expansion initiatives. Operational resilience defined our Q2 FY26 performance. The temporary impact of the Dahej plant outage was effectively neutralized through a rapid pivot. Production was swiftly relocated to our alternate plant and supplemented by capacity from key outsourced partners. While this strategic maneuver ensured we maintained our volume trajectory, it did incur additional temporary costs related to contingency production arrangements and plant rebuild expenses until the insurance claim is fully recovered. Some of these costs associated with loss of profit will be claimed in FY27, aligning with the planned resumption of operations at Dahej SZ organic plant. Having said that, our core business sustained its market position and achieved stability, navigating persistent geopolitical uncertainty and volatile pricing. Before the detailed financial overview by our CFO, here's a quick summary. We delivered 8% revenue growth in Q2 FY26. Gross profit improved by 16%, driven by 350 basis points margin expansion. However, EBITDA and PAT were affected due to elevated operating costs as indicated. Let me now share a key update during the quarter under review. We have taken significant steps to enhance our corporate governance framework in line with best corporate governance practices. The board has approved the separation of the roles of Chairman and Managing Director effective October 1, 2025. We are pleased to announce the designation of Mr. Anurag Surana as Non-Executive Chairman of Neogen Chemicals Limited and Mr. Sanjay Mehta as a Non-Executive Chairman of our subsidiary Neogen Ionics Limited. Furthermore, we welcome Mr. TCN Sai Krishnan as Executive Director of Neogen Chemicals Limited on the board. These appointments, including the designation of the non-promoter family members as chairperson, reinforces our commitment to robust independent oversight. Moving to strategic expansion initiative in battery chemicals. Greenfield facility for electrolyte using MUIS technology at our Pakhajan Dahej PCPIR plant. We are rapidly moving towards commercializing our greenfield plant. We anticipate to complete mechanical completion before the end of this year and then commence trial production followed by commercial production in first half of FY27, which is April to September 2026, and electrolyte salt in H2 of FY27, aligning with the expected rollout of ACC battery capacities in India and growing non-FEOC global demand for the salt. Specifically, the additional time taken for the salt is to completely homologate the technology from our JV partner from Japan, which is what cost slightly more time for the same. This momentum is underpinned by recent critical approvals. A leading Indian gigascale customer has successfully completed the stringent production part approval process, also called as PPAP, and approved our Dahej plant for long-term commercial electrolyte supply. This is a significant milestone and maybe the only plant in India to have achieved so till now in the history. Furthermore, our quality systems have received provisional approval for lithium electrolyte salt from key international customer with final approval anticipated in Q4 FY26. We are also actively working with several other international clients who have already approved our electrolyte salt samples, and final approvals are underway, expected in Q4 FY26 or Q1 FY27. These milestones validate our quality and position us as a reliable partner in the lithium-ion supply chain. In a recently participated international event, we received a very positive response from the international community with the joint venture because we offer the only Indian combination of low cost from India with reliability from international reliable technology for electrolyte salt, specifically LiPF6 from India, which has seen very positively by the customers. Execution of joint venture agreement between Neogen Ionics and Morita Investments. So we are thrilled to announce this major strategic milestone, the formation of the first Indo-Japan joint venture in the crucial battery material space. This JV formed by Neogen Morita New Materials Limited, or NML as we describe in future communication, a wholly owned subsidiary of Neogen Ionics Limited till now, is designed to leverage synergies and capitalize on the rapidly expanding lithium-ion battery market. NML will be dedicated for producing, developing and selling solid LiPF6 salt, a key ingredient for lithium-ion battery electrolyte, along with other related products. Critically, this facility will be the only non-FEOC compliant plant for electrolyte salt in India, utilizing proven established Japanese technology, offering a significant advantage in terms of cost, speed and reliability. Under this agreement, NIL will hold a minimum of 80% ownership in NML, with our JV partner MIL holding a maximum of 20%. As you know, US lithium-ion battery cell producers must comply with foreign entities of concern guidelines to secure the lucrative US government tax credit, also known as 45X credits. This requires a complete transition to non-FEOC suppliers by 2027 for electrolyte salt. Consequently, most international customers are proactively accelerating their supplier transition to non-FEOC sources throughout 2026. This phase shift is essential for them to mitigate compliance risk and ensure uninterrupted eligibility for the tax credit. Our ability to offer a non-FEOC compliant established LiPF6 technology solution positions Neogen at the forefront of this mandated global supply chain pivot. We are executing a long-term strategy to evolve into a stronger technology-led and agile specialty chemical leader. This strategic alliance with MUIS and Morita are key to accelerating our entry and cementing our position in the high-growth battery materials value chain. Despite global economic headwinds, our commitment to volume growth, enhancing operational efficiency, and driving transformative projects reinforces our confidence in achieving a robust long-term trajectory and delivering sustainable value creation. This concludes my opening remark. I now request our CFO, Mr. Gopi Krishnan Sarthi, to share financial highlights for the period under review.
Thank you, Dr. Harin Kanani. Good evening, everyone. Welcome to Neogen Chemicals Q2 FY26 earnings call. I will share the key financial highlights. Please kindly note numbers are on consolidated basis. Q2 FY26 revenue reached 209 crores, up 8% year-on-year. This growth was achieved through sustained demand and increased volume across base and also organolithium business. This was mitigating the effect of the Dahej plant unavailability. Neogen Ionics contributed 5.42 crores to the quarter's revenue. Organic revenue for the period stood at 184 crores, reflecting 12% increase while inorganic revenues stood at rupees 24 crore. EBIT for quarter was at rupees 30 crore. Although the gross profit held steady, EBITDA margin percentage was constrained by various factors. Some of them were higher employee costs stemming from performance-linked incentive and long-term benefits and strategic new hires. Two was sharp rise in the insurance premium following the recent fire incident, and increased job work and conversion costs. As indicated by Dr. Kanani, we expect to recover some of these expenses under the business interruption loss of profit insurance plan in FY27 once their operations are resumed at Dahej SC's organic plant. Neogen reported a PAT of 3 crores for FY26, Q2 FY26. This reflects the cumulative impact of several factors that constrain profitability, namely higher operational costs as shared earlier, increased finance costs related to the capital deployed for inventory and plant rebuild following the Dahej fire incident, continued investment in the organic Dahej SCZ while we await the final insurance payout for the fire loss, and initial cost at Neogen Ionics. And also lower utilization at Dahej plant, pending both final approval for electrolyte salt and delayed market demand for electrolytes. Moving to the key development during the quarter under review, to ensure that we maintain our growth trajectory and operational stability, we have successfully executed a private placement